We're in reflation right now. Economic growth is not accelerating fast. It's not decelerating. So you just don't short that market. You just stay and be patient and realize, let's just make money while we can, as safely as possible. But you don't fall asleep here because we have the most dangerous stock market in history. If you look at the valuations, if you look at the construction of GDP, it is extremely dangerous. And you just have to pay attention. The inflation-deflation economic cycle that I created showed that in September, we took a jump from sector 2 and 3. So sector 2 is disinflation, 3 is stasis, 3 is reflation, with a little bit of growth thrown in there too. And I haven't been net short the market since 22, haven't had any shorts except for a small high yield short since the first part of 2023. I still maintain that small, unprofitable 1.5% short in high yield because I think that's going to be where the earthquake really begins in the high yield bond market. If you look at some of my favorite valuation metrics, of course, the Buffett indicator, 207% of GDP. This president came in, Ronald Reagan, and rejuvenated the whole country. And he slashed the marginal rates, the highest rates. In fact, he slashed marginal rates across the board. He even cut the capital gains rate substantially. He underwent massive deregulations. But when he came to power, the first couple of years where he was in power, 81, the GDP grew at 2.5%, whoop-de-doo. And the second year, 82, it shrank by 1.8%, the GDP. Donald Trump is going to take the reins of power. The total market cap of equities, 207%, as opposed to 40%, which it was under Ronald Reagan. And the national debt to GDP is 125%. It's absolutely a debt burden that's going to drag down GDP. Public and private sector debt's at a record. Ronald Reagan had 30% national debt to GDP. He had plenty of room to spend and to stimulate. We don't have that anymore. We also had a booming labor force growth. Women were entering, that was the last decade where the women came in after the 50s and 60s and 70s and the 80s. Labor force growth boomed from 63% to 67%. That was the highest we've seen in 45 years. Nothing like that has ever happened again. So it's going to be very difficult for Donald Trump to duplicate what Reagan did. If you look at things like price to sales of the S&P, it's at a record high. We have a huge bubble in real estate such that commercial real estate and regular residential, it's just not moving. The transactions have dried up because people can't afford to buy a new home. When you add taxes and insurance to the equation, it's just unaffordable. So there's a lot of challenges that aren't going to go away just because you elected Donald Trump, unfortunately. And we do have this reconciliation of asset prices. Asset prices don't belong at 208 or 7-8% of GDP. They just don't belong there. They belong like 80 to 100% just to be around fair value of GDP. So you can make the argument, well, GDP is going to skyrocket. I just told you why it's not going to skyrocket. It really can't. I haven't even discussed the fact that Reagan came in and he didn't impose, massive tariffs and deportations either, which is a threat that Donald Trump is threatened to do, which would be a depressant to growth. Half of GDP growth comes from productivity and the other half comes from labor force growth. Well, you're going to eliminate a lot of people that are in the workforce if you deport 10 million people. You're going to have a problem in the credit markets. You're going to have a recession and the country is going to devolve into chaos. And if you believe that, and you have a money manager that's looking out for that is not going to just tell you, oh, just buy and hold, everything's going to be great. Stay the course, stay in your target date funds, don't sell. You could have your retirement plans wiped out. I think it's very possible to happen, yes. It could be more than that. Unless you're going to make the argument that GDP growth is going to skyrocket in double digits for many years. And I just can't come up with that scenario. In fact, it's more likely to have a recession, and then the recession comes and deficits go from $2 trillion per annum to $6 trillion. And then you have a problem in credit markets and you could have GDP crash and revenue crash. That's more likely to happen. I don't think Donald Trump wants to touch Social Security. Well, if you can't touch Social Security, Medicare, Medicaid, and defense and the interest on the debt, what are you going to cut? You might be cut a few $1 billion here and there. And if those kind of cuts, what would that do to the economy? Listen, there's no free lunch. I don't think there's any easy get out of jail free card here. It's one of the law of thermodynamics. For a reaction, there's an equal and opposite reaction. And there's going to be a negative reaction of having decades of artificially produced negative real interest rates and a decade of nominal rates that were close to zero. You get is massive asset bubbles and a massive increase in debt, and those have to be reconciled. And it's painful when it happens. And I don't know any way out of it. Maybe I'm just not smart enough to understand it. Maybe it's something I never thought of. Elon Musk is smarter than me. He can land a rocket ship on a platform. I can't do that. But maybe he's come up with something that I don't know of, and history has never witnessed, but I doubt it. 10 of the last 14 years, interest rates in real terms were negative. That's unprecedented in history. What happens when borrowing costs in real terms are negative and in nominal terms, they're pretty much free? Ooh, people borrow a lot of money. So then we have things like private credit, which was something that didn't even exist in the global financial crisis. Now it's $2 trillion worth of businesses that they can't get a bank loan. They're highly leveraged businesses. They can't get a loan from a bank. They can't float debt in the corporate bond market. So they go and borrow money from a private credit dealer. And since it's private, there's no market for it. And when a recession comes, people are gonna be like, hey, you know that, $100,000 I gave you, can I have that back? Or what's it worth? I don't know. That business went under. I mean, these are things that are gonna happen. Total non-financial debt is now 260% of GDP. That's a record high. We have a triumvirate of bubbles in real estate, equities, and in credit. That has never been the case before because we've never deformed the cost of money and its supply like we've had before. So there are consequences, and they're gonna be dire. Now, having said all that, people say, oh, Mr. Pento, you're a perma bear. No, I actually run money for a living, and we have a nice solid year of returns here. I wouldn't have very good returns at all. They'd be negative if I was just like, hey, let's just short the market and sit in cash. Wouldn't have a very good relationship here. I have an inflation, deflation, economic cycle portfolio. It monitors the second derivative of inflation and growth and tries to keep me nervously long in the right sectors until time is right to sprint for the nearest emergency exit, which I think is a very narrow door. We're in sector 4, which is reflation. So you don't short the market in reflation. Growth is not booming higher, but it's slightly accelerating. So you go long higher beta stocks, cyclical stocks, quality growth stocks. You don't own any long duration bonds. And you change when that changes. You watch it every day. When the copper gold ratio begins to plunge and I see break-even spreads plunge, and when I see financial conditions tighten and credit spreads blow out to the points where I have triggers in my model, I will change. Until then, I'm not going to. We very well easily can go back into sector first 3 and then maybe 2 or even 1, which is a recession and deflation. That's still a real possibility, but it's not an imminent concern of mine. Predicting what's going to happen in late 25 or 26 is nonsense. What's happening now in the next 3 months is how I manage money. And it's sector 4 right now. So that's where I'm allocated. So the home price to income ratio is at a record high. It should be around 3, and it's right now at like 5.6 or something like that. Well, when home prices go down, unless you're going to make an argument that incomes are going to surge from here, for all the things I mentioned, I don't think it's going to happen. That's very damaging to banks, and it's very damaging to the net worth of a lot of people. Many of them have multiple homes. That's very painful. But that's mean reversion, and I believe in reversion to the mean. If the stock market gets back to a level that's 100% of GDP, market cap to GDP, that's a 50, 55, 60% crash. What effect is that going to have on the economy? It's not going to be beneficial. It's not going to be beneficial for investment banks. So the Fed's going to have to step in. I don't know when they step in, but at some point in that process, in order to avert a depression on steroids, they'll step in and they'll buy trillions and trillions of dollars of government debt like they've done before. But there won't be any end to it immediately, for sure. And they'll have to do it, and they'll just take those bonds out of the public's domain, so out of the realm of public price discovery. They'll warehouse them in cold storage on their balance sheet. So you're talking about the recipe for another. This is what we were condemned to do. We're going to go from recession, depression to stagflation and back and forth because the economy isn't real. It's not a market-based economy any longer. It's based upon the whims of people like Janet Yellen, Jerome Powell, and the carnival barkers in DC. If you're buy and hold, 60-40, set it and forget it, portfolio holder and holder of multiple houses, don't go to sleep on your money. Be vigilant. Be ready to cash out when things turn sour, because I know that the Federal Reserve has been ready and willing to inculcate to people over the decades that, hey, if things go bad, we'll just print our way out of it. Well, if things go bad because of inflation and debt, if those are the salient issues, and how do you print yourself out of that? How do you borrow and print yourself out of that? So the bond market could go absolutely haywire. And I would like to impress upon you, this is not, your father's or grandfather's stock market. Things are very different. No one would have ever believed pre the global financial crisis that the Federal Reserve would print, $8 trillion, but they did. Things that you never thought would happen in a free market economy are happening. And prices don't always bounce back. It took like from 1929 to the 50s for the stock market to here from the Great Depression. And in Japan, they're still waiting to get back to even from 1989 in nominal terms. And the Shanghai Composite is down significantly, I think 45% or so, since 2007. So things don't always bounce right back. And for people who are close to retirement, they might not have decades. They don't have decades to make a comeback. So you don't have to be a passively managed pigeon. You can be more active.